Folks, I want to welcome you to the midweek roundtable. I am here with my guest, Jeff Zananeri. Jeff, welcome. How are you today?
I'm good. Nice to be with you, Roger.
You as well. You as well. So the S&P today is the 19th of August, and I looked at the S&P. It's making a new high today, and I looked at the last time it made a new high. Lo and behold, it was February 19th, exactly 6 months to a day.
Interesting how that works, isn't it?
It's very interesting. What do you make of all of this?
There's so much to unpack, man. It's something we've been talking about for months. The fact that we've had to navigate these markets, it's both a gift to be able to do it, to be able to devise a plan and to unpack it, but it's a lot. Nobody thought we'd be at new highs in the middle of the summer or the end of the summer of 2020. I know I didn't. I thought we could backfill, but this extra, 5-6%, 7% in the S&P has been a little bit surprising. Extra 8-9% in the Nasdaq's been surprising. But at the end of the day, there's a lot of money sloshing around out there with nothing to do, nowhere to go home. Money needs a home, and money goes to where it's best taken care of. And what are you going to do? There's no yield. You can't. People that would have bought bonds in the past, they don't have that option. And sitting in a bank account, your money's depreciating with inflation right now. The Fed's going to come out today. They're going to talk Fed minutes, and they're going to talk about they want the inflation to run hot. They have no problem with inflation running hot. And that's bad for savers, and that's good for investors.
Right, right. Do you think we're going to see a huge uptick over the next 6 months in basic consumer staples and products and things of such nature?
I mean, when you're in a bull market like this, it's hard to tell where things are going to spread. I'm a little bit cautious on the broader economy with the election, with so many things in the air. Like this stimulus bill, the second stimulus bill, it's not a done conclusion. A lot of people are saying it's a done deal. It's not a done deal. And there's a whole lot of people in this country that need that money. They're
Yes.
not everyone is sitting with a nice big trading account and, house paid for, et cetera, et cetera. People need that money. And so what happens if that 30% of vulnerable people are taking consumer staples are something everyone buys. That's why they're called staples. So if you take that 30% out of or buying 50% less, how does that not affect the balance sheet?
Right. Let me ask you this question. I've been following retail sales. I've been really hot on retail for the last about 3 weeks to a month. And I've been seeing a lot of retailers starting to make their headwinds in the S&P. L Brands, Gap, Haineswear, Best Buys. The S&P is becoming a lot less focused on hard tech and biotech, and becoming a lot more broader, which is one of the reasons I believe the stock market
Is improving.
started coming up because of that as a whole, as opposed to just the Nasdaq 100, everything moving in there. But here's the interesting part. Walmart came out yesterday, said that online sales have gone up 97%.
Right.
Today, just a few hours ago, Target comes up with I think 97%. I keep some massive, and same, but the actual brick and mortar only 10% from last month. Do you believe over the next few months, with schools starting, closing, with all of these vaccines coming, increase of COVID, how do you think retail sales is going to shape itself over the next The reason I'm asking you is you're obviously very well aware that retail sales makes up so much of the economy. So I wanted to get your take, because it's obviously going to have a big impact with the GDP.
Well, there's two ways to think about this, right? So retail sales, you can combine it with consumer discretionary spending. And consumer discretionary spending on things like going out to dinner, taking vacations is down, and is going to be down, right? But that money needs to go somewhere. So people are finding they have extra money to do things like retail, like buy a new TV or, buy more clothes, et cetera, whatever. That's why I think you're seeing that strong bid in the Targets, Look, one thing that was interesting yesterday is Walmart came out with that number. What was the best stock yesterday? Amazon. Amazon was up 4%.
Yeah.
Walmart traded down. People
Yeah.
are like, well, if Walmart with 15% of their business has seen that double, what is Amazon doing with 100% of their business?
Right. 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 And also other retailers like Best Buy is also seeing that type, because you got the tech, you got the tech and you have the online. So you have the double whammy. That's also seeing a higher relative strength.
Yeah.
I'm actually, the way I'm, me, I'm always I'm the guy that's buying the shovels when gold is going up. I'm always trying to get in on the other part.
Right.
I'm actually really focused right now on the freight on the freight shippers.
Yeah.
Like the UPS, the FedEx, because somehow, some way that has to get to your house. The things that you buy from Amazon and Walmart. And if these things are seeing 197%, 97%, and like you just mentioned, God only knows what Amazon is seeing. Best Buy is I just started buying things from Best Buy again. They started getting things back in stock. They were out of stock for 5 months now, 6 months. They just
Right.
just now literally started getting. I needed a video card, and Amazon is still gouging a little bit, but Best Buy I was able to get it and delivered in 24 hours. So for whatever that's worth. But the bottom line is, do you believe this is going to shape the market going into New Year's, or do you think we're going to see a strong political cut through as we get into the elections, distort this market? What do you think?
I think that there's going to be a helter-skelter early fall, followed by, if I had to predict the market, and I do predict these things, if I had a proper cadence for this, I think we're going to have a really rocky, bumpy early fall leading into the election, followed by like an absolute face-ripping rally into the end of the year. I think it'll be the kind of dip that scares people again, where a lot of people make a big mistake and puke all their winners. And then I think it's going to be kind of like this early part of this year where people regret having sold March. And then they look back and they're like, wait, what did I do? It's going to be even worse because they're going to really pin them up into the end of the year. And then 2021, that's going to be a different matter. Then we're going to deal with the hangover of the whole, we're a year into this. Vaccine is still only being used by 20% of the population. The economy is still running with 8.5% unemployment. GDP is still sluggish. That's going to be a different story. But I think we're going to have a blow off top in the stock market towards the end of 2020.
I do.
Still led by the big winners. That's my best case. I
agree with you. And I agree with you. And one of the biggest reasons why I agree with you is because if the momentum on retailers is heating up so hot right now, we're not that far from the end of the year from, in terms of the quarters. And I believe that retail is usually what drives the market towards the end of the year. Earnings on retail come out last. So I agree with you. I think we're going to have another shakeout, and then we're going to end the year on a strong note. But here's a better question. Do you think the rally is going to be a broad-based rally, or do you think it's going to be more centric in tech and biotech?
That's a hard question. I'm going to answer it like
that's why I'm
going to answer it like this. You say retail, and I say Best Buy is a winner, and I say Macy's is a big-ass loser. I say Kohl's is a big loser. I say you have to know your stocks. You have to pick your stocks. You have to time your entries. So broad sweeping statement, tech. Do I want to be short Amazon? Heck no. Do I want to be short Tesla? Tesla's a tech company. We've talked about this before. Winners win more. Losers can stay alive for a while, but at some point they have to invent a new way to play the game. Look at Kodak. They have all these desperate moves. They were trying to mine Bitcoins a couple of years ago. Now they're trying to create ingredients for pharmaceuticals. That's because they don't have a game. People that have a strong game that's working, that's winning, that thing continues. The only thing that can stop look, Apple is a $2 trillion company today. Do you remember when people are like, oh my gosh, why is it $1 trillion? Guess what? They're making $50 billion, like what, a quarter they're making? And they're growing at 30% a year. How many companies in the history of the world can do that?
And it may continue at the same rate because which is what I was saying, with the 5, Apple now has to, because 5G is literally here,
Yeah.
all of their iPads and some other. I was doing a lot of research.
Yeah.
They're set up for the 4G network. They're not set up. So can you imagine the amount of people buying, especially as we get into right now? Hey, if you use this, you got 4G. You got 10 times faster. People are going crazy.
They're a high margin utility. If
Yeah.
you really want to break down what it is,
It's
a necessity
right.
for life, but they have awesome margins.
Yeah.
And amazing growth because they're worldwide and they're being adopted in places in a larger way all the time. They're penetrating deeper and deeper and deeper into these different countries.
There's a lot of folks. There's a lot of wisdom in what Jeff just said. Notice he said it's like a utility. Well, let me expand for those who are not in the, because we've been talking about this for quite some time. This medical pandemic caused a different type of a downside. Because the economy wasn't in a bad shape. It was the pandemic that caused the market to come down.
Right.
And when that happened, utilities, water, power, electricity, the type of things people need to survive.
Yes.
Need. All of a sudden, the internet started joining that group because how are people working right now? How are people communicating? How is Jeff and I doing this right now? Through the internet. So the internet, the computer, the things of power that allowed you to communicate, which Apple was the world leader in, just became, their market value just became higher and higher because you need it now. Before, oh, it's nice. I have this nice little iPhone. I can talk to you on phone. I can call my grandmother to see if she's going to make me some dinner. 30 years ago. Now people need this. I had a meeting. I literally want to take a walk. I just took my phone. I had an hour meeting and I took a walk and I had a meeting. I needed to do that. If I didn't do that, I wouldn't get paid.
You need Zoom more than you need a car. Think about that for a second.
That right there, and that's something, right? That says a lot.
Yeah, we change the way we live as people. We
Jeff,
do all the time.
People who didn't know, people who are going to be watching this 2 hours from now on a recording, who didn't know what Zoom was 5 months ago, are now doing this. Yep, he's right. Think about that. Think about the massive psychological change in your mind. You didn't know what Zoom was 5 minutes ago, and now it's become more important than your car. So listen, it's a necessity.
I talk to my wife. I say, we have 2 cars sitting in our driveway all day. Do we need both of them? We don't. And at some point, we're going to, we have cars, whatever. Point is that there's need and then there's like having, it's a luxury. We like it. We have luxuries, right? But it's like, if I told my wife, I'm like, you can't have Zoom anymore. You can't have Amazon Prime deliver stuff to you anymore. What? It would be like this choking thing happening at me. That's so so when people say, is that too expensive? As people in society start to realize that they need more and more, the pricing power increases. And so the only problem with utilities, the worst part about utilities, their business, is their margins are razor thin. That's why they're defensive thin. Like if rates go lower, people like utilities because they're like, oh, they can make more money now because they're not pressed. Right. They're not pressed because the margins are thin. They get a little bit of expansion on their margin. And you look at some of these Zooms and et cetera, they have these huge margins, 30%, 40%, 25%. So there's a lot of room for these guys to make a lot more money than they do right now.
The net margins are huge on cloud tech for obvious reasons.
Yeah. So for people like to say, when people are analyzing them as expensive based on now, they're not viewing it properly. They don't realize how deeper and deeper entrenched these guys are going to get and how much more leverage they're going to have to even have more pricing power than they already do.
Yeah. So let me ask you this question. Let me move on to something.
I got on a tangent. I'm sorry.
No. This was great because you see, here's the thing. A lot of people don't understand. They're not understanding that the world is literally going through a change in front of our eyes.
Wow.
That this is a different world we live in. This is a stay-at-home society. You're going to have people, and this goes back to our conversation that you and I have. You know that there's this group of people. As soon as there's a vaccine, the world comes back. Everything's, and then there's you and I are like, no, it's just the beginning of it. there's going to be different stages. Certain people are not going to be able to take it. It's not going to work for everybody. There's going to be competition. There's going to be that's just the beginning. That's that's when you open the door to a new beginning.
Yeah.
But because that's how society works. Nothing is
Right.
binary.
No.
Only computers are binary. People are not binary.
No,
People are anything but binary.
right.
It's going to be 2 steps forward, 1 step back. 2 steps forward, 1 step back.
That's right.
But the point is, it's something we need to talk about, because a lot of people are not talking about it. A lot of investors and traders are not talking about it. The world has changed, and it's not going to come back to the way it was. It may seem like it, but it's not for a long, long time. But let me ask you this question, and this is something we talked about, housing starts. Did you see the housing starts number?
Yeah, blowout. Best ever. Yeah.
Best- Unbelievable housing starts. Here's my thought. Interest rates are low. A lot of people are refinancing their homes. They're taking money out of their homes because they care about payments. They have the how low is my payment going to be mentality. How much of that do you think is contributing to retail sales and external growth? Because if you think about it carefully, that money is not really growth. It's borrowed money, and that
Right.
money is going to go back
That's
into the Fed.
That's the liquidity that's being pumped directly into our personal economies from the broader economy from the Fed. That's
Right.
That's that pass down of liquidity. That's how that money comes through to you. So the problem is the same thing happened. So after 9/11, right? Greenspan was faced. I'm going to do a little bit of a little economic history. So Greenspan was in a bit of a conundrum after 9/11, right? The economy was already in tatters. NASDAQ had already went from 5,000 to 1,000. There wasn't much of an appetite for growth stock investing, and rates were still pretty high. So he had some room. It was like you could have a money market bank account making 5%, if you remember. And mortgages were like 7%, between 6 and 7.5% for a 30-year fixed rate mortgage. And so Greenspan was like, I'm going to take rates lower. He took rates lower. And what happened was a lot of money got borrowed and put right into housing. And the perfect storm of like deregulation, really lax lending standards, with really easy to get money at low rates, created the house being the personal ATM machine, right? So the difference being is that was used like for luxury and created a bubble in housing. I don't think we have a bubble in housing right now.
No.
I think if anything, we could get a bubble from here. So to answer your question, I think there's a lot more room for housing to run higher. I think there's a lot more room for people to leverage their personal balance sheets through their housing ATM machine.
Do you think that over the next couple of years, if this continues, it is going to become a similar problem as it did in the early 2000 or mid 2000s?
Roger, I think the name of the modern game is like rotate your bubbles. I think I don't have a problem with that because I know how to play that game. But I think if people are unaware that these are controlled kind of in a way until they get out of control, expansions of asset prices, then they're not paying attention. Like the Fed's only mandate really right now is seeing a buoyant stock market. Everyone knows that they're going to stay on zero forever for years and years. But to keep the stock market going is the game. To keep people refinancing is the game. And so if they get these flare-ups in these pockets, if they get crypto, so people, I'm going to use this as a segue to ask you about crypto. Yeah. I had one of our viewers who watched our show said, talk about cryptos. In my opinion, cryptocurrencies are an interesting animal, right? Because they're called currencies, but they're not really used as a currency, because if you ever tried to do a transaction with a cryptocurrency, you're like out 5-6% just on slippage. For people that don't know what slippage means, just doing a transaction to get crypto, to send crypto, you're out like 6%. So that disqualifies it from being a currency. Nobody in their right mind is going to pay an extra 6% tax to buy anything, right? But crypto being hot and being a thing is a product of all this liquidity having to find different projects.
Right. I think it's just another example of what I was talking about, whack the mole. Something goes up, something comes up, and right now people need. It's like what you were saying. It's like what you were saying about Warren Buffett. He needs something to invest in right now, and all the stocks are expensive, so he's going to go into gold. I think it's the same thing happening with the crypto market. I think the liquidity is making people invest, diversify, and pump money into the markets. My fear is that if too much borrowed money goes back into the market, it's going to create the inevitable much faster. But I think the fact that the Fed is keeping rates so low and so in line is going to offset that and going to buy people more time, not investors.
There's a couple of aspects that work in our favor, in my opinion. Banks, believe it or not, right now, a lot of the bigger banks like Citi and Bank of America and JP Morgan, not Wells, they're not well run right now, but these other banks, they have extremely good balance sheets and high capital reserve margins. So they learned their lesson, right? And they're really, 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 what's the word I'm looking for? They've been really careful with who they've given money to. For instance, right now, even with refis being as low as they are, it's hard to get a cash out refinance. So if you go to a bank and say, I want to take $100,000 from my loan because I have all this equity in my house and give me a lower rate, they'll say, we'll give you a lower rate, but not so easy to get the cash out aspect of it. And that's what got them in trouble in the first time. So I think there's a lot of practices that have been put in place since then that kind of make this a little bit of a different situation.
Well, that's a great answer. And I hope that's happened because that's a major concern I have, especially if the level of inflation doesn't, if the level of GDP continues to fall or lag behind the inflationary aspect, it could create a major problem down the line. But again, I'm looking, you and I are talking probably closer to the next presidential cycle, if I had to guess.
My hope is that we have a series of like mild heart attacks.
because if we do, and folks, the reason
while we get fit, that's my hope. My hope is that we don't have like this like big bang, like everything crashes at the same time. Everybody panics at the same time.
Yeah. It's much healthier. It's much healthier when they happen in little pieces because it relieves the pressure from the market and allows. And
if that whack-a-mole situation happens the way we think it will, that's exactly how it's going to play out. You're going to have like one sector under heat for a little while and one asset class, and then the other one's doing okay. And people are okay from this and they're not, you know what I'm saying? It kind of like manages itself. But when you have everything collapsing at the same time, that's when you're really, really like scared.
Right. And that's when investment bankers make really bad decision, margins make really bad decision, and everybody just tries to cover their butt, and then things go out of whack. And I truly hope that does not happen. And based on what I'm seeing, I agree with you. I don't think it will.
Right. But you got to be prepared for everything. That's why it's important. Let me get salesman-y, like be a little bit salesy here. That's why it's important to have a system where you trade like Roger does or I do, where you're prepared for all variety of different scenarios. And when you have these scenarios happen, you're dealing in a plan of action rather than reaction, and you're not panicking. You're not panicking because you're from a position of power and strength. It's very important. It's very easy when everything is going up to just sit back and say, I'm just going to buy some more QQQ and some SPY, and I'm just going to chill. QQQ and SPY and chill. Maybe I'll buy some Litecoin because my buddy put it on Twitter. But when things get a little helter-skelter, if you have a good system, not only are you not going to make a bad decision, which is probably the most important thing, and destroy your entire financial life, but you'll be active with the market doing good things.
And you'll have less volatility and movement, and you'll be able to sleep better at night as well.
All of it. And because it's invariably going to happen. Like at the minimum, the mild heart attacks are coming.
Oh, absolutely. The momentum levels are telling us it's going to happen. We went to 95th percentile. We're not going to get out of there without a nice little cool. But it doesn't mean we can have to go to 0. It means we can go to 50 or 40, and that will relieve plenty of pressure. So I do agree with you 100% on that. Yeah. So folks, let's leave it here, Jeff. This was a great session. I think we covered just about everything under the sun. If we stayed a little longer, we'd probably be talking about, God only knows what else, pharmaceutical.
College. We're talking about college tuition, the bubble in college tuition.
Yeah.
They got their North Carolina, UNC. They got their tuition and they got their housing fees, and then they canceled school 3 days later.
Right. I was reading that this morning actually, and other schools like Notre Dame and a few other ones that escaped my mind.
What's going to happen? Like, there's going to be clusters of people getting sick.
We talked about it. Remember about a month and a half ago, I said one teacher gets sick, and then the whole. It sounds really good in theory.
This is going to be the world. This is why it's not going to be binary. It's going to be a process of this.
Right. So, folks, be careful, stay safe, and you and I will be back next week at our regular time. Jeff, thank you very much. This was a really, really great session. I'm glad I got so much good information out of you.
Likewise.
Appreciate it. Thank you. And folks, if you want to send us what I call love letters, if you want to suggest something, recommend something, hear us talk about something, please send an email to jeff@joyofthetrade.com. That's jeff@joyofthetrade.com. Or if you'd like to send me an email, please send me an email to support@MarketGeeks. That's my old email. I use it. It gets to me real quick that way. Thank you and have a wonderful week ahead. Jeff, thank you, and I'll see you soon.
See you soon.